Okay, let's kick off. Business Risk Index, January results for 2023. Welcome back, everyone. Great to be back online with webinars again. And I've got our trusted Chief Economist with us, Anneke Thompson. So Anneke, thank you for joining us as well.
Pleasure. Thanks for having me.
So look, lots happening. It felt like Australia was certainly back to work, working a lot longer into December than historically they would. But January felt quite slow for people to return. So maybe that sort of shifted a little bit, where people are working later in December, coming back later in January. But the year is well and truly off to a flyer. We're already halfway through Feb. We've got some fantastic results to share today. There's still plenty in the media on a daily basis about interest rates and the RBA and inflation and housing and everything else that comes with it. So there's plenty of doom and gloom out there, and we are expecting it to certainly get tougher. So I've got some really good results to show and talk about, and of course, Anneke's got her take on it as well. Before we get into it, CreditorWatch is a commercial credit reporting bureau, but we do have a raft of really fantastic products, from customer onboarding, onboard a customer faster, more efficiently, and improve customer service with Apply-Easy, all the way through all of the required due diligence and assessment tools that we've got in place, and of course, ongoing risk analysis through monitoring, alerts, and health checks. Very briefly, the key highlights about CreditorWatch for those that are new to CreditorWatch or new to our webinars. Over 55,000 companies around Australia are using us. You can run a credit report, credit rating on any business or company in Australia, including sole traders, trusts, and partnerships. And 90% of our customers are using us exclusively, which means the data that we've got in our reports, in our bureau, is really, truly unique to CreditorWatch. So enough about that. Let's jump into the economic update. So over to you, Anneke.
Thanks, Patrick. So thought I'll jump straight into what consumers are thinking at the moment, because it's hugely relevant to what happens with the cash rate going forward and interest rates going forward. So we saw sort of a plateauing of consumer confidence towards the end of last year, and I think that was related to many people in the community believing we're coming to the end of the interest rate rise cycle. Obviously, the news at the start of Feb, after the RBA's first meeting, and the accompanying statement that came with that, has really put a bit of a downer on people's confidence, especially if you have a home loan, but even for renters as well, because everything's getting more expensive there as well. So we saw another decline in consumer confidence, and it was a very big one in Feb, and they take this survey, I think, as the interest rate announcement is happening. So it's very up to date and on the ball. So as Westpac said, consumer confidence hasn't been this low since April 2020, which was the start of the pandemic, and then the last time it was this low was back in recessions. So look, it's not looking good. People are very, very worried about their finances this year, and rightly so if you have a home loan and it's coming off a fixed rate in the next couple of months. But I guess some good news for the RBA to see when it comes to retail volumes. So it's a bit funny at the moment looking at retail trade, because the figures look good, but obviously we've got a lot of inflation packed in there. So it's is it price rises or is it volume rises? But we got some data at a couple of weeks ago showing volume changes in purchases. And that first column there shows how volumes have changed in what we've bought. These are in percentage terms year on year. But then the second column shows how volumes have changed since that first interest rate rise, so since May 2022. The good news is consumers are responding. So we've bought less electronic goods, less furniture, floor coverings, less clothing, less personal accessories since the interest rate cycle. So RBA would be happy to see that. In terms of retail trade, though, it looks like we're spending more just because these goods are costing more. So as consumers, we are starting to do our job in spending less and trying to put a stop to inflation. But I think there's still some work to do there before we actually see some real falls in that inflation rate. And going to the next slide, please. Looking at how businesses are feeling. So consumers is obviously one thing. Business NAB reports on business conditions, and that is a bit different. So business conditions actually improve, but remember this survey was taken in January, so before that February interest rate announcement, which I think will have a very big impact once we see the survey results coming out in early March. I think will be the next one. So it is wobbling around. It was declining quite slowly throughout 2022, and then it started declining quite abruptly towards the end of 2022, but picked up again in Jan. Capacity utilization was falling, so that effectively means that businesses were getting slightly less busy, which when we go through our BRI data, you'll see that sort of correlates with what we're seeing with our own data. But then capacity utilization increased slightly in Jan, so businesses got slightly more busy in January. But again, I think once they take this survey after that interest rate rise, and especially once businesses see what consumers are thinking, these conditions will deteriorate once again. And I think businesses will be sort of on the same page in agreeing that conditions are going to get a lot tougher in 2023. So just summarise oh, sorry, Patrick.
I was just going to say with some of those Q2 financial year releases from public companies this week, while a lot of them were, well, some were good, some were bad, there's almost a unified disclosure that January was soft. So while the reporting figures went to the end of December, even for those organisations that performed really well, they were quite upfront about the fact that there was a significant change in their January trading conditions.
Yeah, there's sort of a lot of foreboding in some of the announcements that, get ready, sort of view into what's coming next with their next 6 months financial results. Yeah, agree. So if we just go to the summary slide next. So obviously RBA governor's all over the news at the moment. He's in Senate estimates. Tough gig for the next 3, or I think he's there for 3 days. But what is really interesting is listening to some of his responses to the questions, and what he's made really clear, and it's really important to understand what's going to happen with the cash rate, is that he intends to get inflation back down to that 2 to 3% range. So not just down, but down to where it's supposed to be. So my take on that is that will require another at least 2 or 3 cash rate rises, which it's hard to envisage now how that's not going to induce a recession, or at least an economic downturn so severe that it will feel like a recession for most borrowers. And what is really of note is that people who took out home loans at the when interest rates were at their lowest have already passed that 3% serviceability threshold. So they will already be struggling. We've got low unemployment, which obviously gives the governor some comfort, and high savings rate, but it hasn't really translated into real wages price growth. So even if wages are increasing, inflation and interest rates are increasing way ahead of them. So if we're above that 3% serviceability threshold, those people will already be struggling even with a wage increase. So real wages are going backwards for most, and also we've got to think about that high savings rate. They're really concentrated in the wealthier, older households. They're not spread evenly throughout the economy. So unfortunately, it's always those borrowers who can least afford it that feel the most pain in these situations. So I wish we could start off with better economic news, but I guess, there's a lot to be wary of going into 2023, but we always caveat this with, in Australia, we are in a lot better position than a lot of other countries where inflation is worse, and household savings and households are in trickier position than they are in Australia. So that is the bright upside, I guess. I'll hand over to you, Patrick, to take us through the results.
There's certainly some positives to take out. It's not all doom and gloom, and I'm very conscious of sort of presenting both sides. And I might just jump back a touch. And if we go back to, if I can get my cursor to work, this obviously this big drop here in business conditions, which was, you know, that back end of 2021, when most of the East Coast, or the whole of the East Coast, ended up in, you know, quite a long lockdown. That really showed the resilience of Australian businesses and how well they had prepared through, you know, the early months, first 6 months, 12 months of COVID. And it was really almost a case of hibernating or treading water and waiting for clarity and certainty on, you know, when we were going to get out of lockdown, when we were going to be able to open up again, and people would start to move around, and trade would restart. So I'm hopeful that we're in a position where we will probably see, you know, a tick down in this graph. However, hopefully we're able to see certainty fairly quickly that inflation's coming down, and there's likely to be, you know, rate decreases, reductions in the future. And I think having that certainty for Australian businesses gives them the ability to, you know, invest in goods, in software, and also hire as well. So provided it's not a really long, prolonged, you know, recession or downturn over multiple years, if we can get some sort of certainty, you know, in the back half of this calendar year, that will certainly provide a bit of a shining light for Australian businesses to get on with it. All right, let's have a look at some of the insights, and I do remind everyone you can ask questions along the way. We'll have a Q&A at the end, so if you do have questions, please just submit them into the GoToWebinar question box. Should be in the control panel there. So some of the key highlights. So you're going to see trade receivables are at their lowest point since we really formally started collecting the data back in 2015. Payment defaults are on the up and have been for quite some time. There's been a big spike in credit inquiries. So we'll take a look at that, but remember that, you know, we want to see what that looks like over a period of time. But what we're taking from that at the moment, and talking to our customers, that a lot of our customers are running a lot of credit checks or health checks across their whole portfolio. So no longer, you know, providing, you know, sort of free credit limits without really doing their due diligence. Gone are the days of going, oh, you know, we know that, you know, XYZ customer is a long-term customer, always pays his bills, sometimes a little bit slow. I think you going into this period, you need to treat customers guilty until proven innocent somewhat. You really want to be sure that, particularly those key customers, those large customers, or those in you know, tough industries, you want to be ensuring that you're doing your due diligence, keeping an eye on them, making sure that you're actioning any alerts that come through that notifies you of changes to their conditions. So credit inquiries on the up as our customers perform credit checks on a lot of their own debtors. External administrations, we expect to continue to trend upwards this year, probably, you know, 10 to 20% above pre-COVID numbers. There's a caveat to that. We're obviously pretty much back to pre-COVID levels. January is a funny month, as we all know. There's a question mark as to how many of those are non-trading, you know, have essentially just been put through a bit of a, you know, the formal administration process, but essentially haven't been trading, and hopefully as a result don't have a large creditors list. Court actions, highest points in September. And then we've got a couple of geographic notes to take away here. Yarra Ranges in Victoria is the region with the lowest insolvency risk. Gold Coast remains very high, and that Melton Backs Marsh area in Victoria has started to rise over the last couple of reporting periods that we've done. From a trade receivables perspective, you can see, you know, this continued downturn or reduction or decrease from 2019 at its lowest level that we've seen. It'll be really important to see this. Typically, this is looking at small businesses, small and medium businesses, where there's a reduction in revenue. There's obviously a squeeze on the profitability of the business itself, and also, of course, a knock-on effect to employment. So never a great sight here, but we have seen the ability for businesses to build back up from low points before. This just gives you a really nice understanding of the percentage change from month to month as well. Credit inquiries up. We saw a big spike through November. December was unseasonably high, and January again. So I think this is a really good indicator that there's a lot of checking going on to ensure that you're trading with good quality customers. You know exactly where your blind spots are, and you don't get any surprises over the coming months as the economic conditions get tougher. We can see there that the overall trend for external administrations is still rising over that past 12 months. January fairly similar to January last year, but the really big question marks come out over Feb, March, November, December. You can see big outliers there. October a funny dip, but you'll remember that there are a lot of public holidays and that Queen's Morning Day as well, which reduced the number of working days, which does have a significant impact on external administrations. B2B trade payment defaults. So these are CreditorWatch customers registering defaults against their customers. You obviously can see that on your credit report, or if a default is registered against one of your customers, you receive an email alert as well. Overall trending up, though, has somewhat come off a touch over the last 3 months. Still up on previous years, and starting to really get back into that pre-COVID 2019 sort of territory as well. Court actions still not back to pre-COVID levels, but certainly a more consistent volume of court actions that are taking place, again showing up on credit reports and through alerts as well. We know that if you think about a debtor's journey to administration, it follows a fairly typical pattern. They slow their payments, which would show up in a credit rating or payment rating. They would then have defaults registered by typically smaller suppliers. You would start to see larger suppliers register defaults, court actions, and ultimately a move to administration. So naturally, we would see that sort of knock-on effect from a slowing in payment conditions. And from a default rate prediction, we've obviously come off a really low base of insolvencies, which is indicative in this in the increase from sort of 4.8 up to where we're at now, sort of the 5.7 mark. We don't have a forecast for significant change over the coming months, but there naturally will be a slight increase, of course, in insolvencies that we're expecting. From an industry insights perspective, so this is where we look at the various industries and rank them by probability of default and also how they're paying, so their arrears rate, so to speak. Food and beverage services certainly well out in front, very flat thereafter, but anyone with exposure to food and beverage, accommodation, bars, restaurants, clubs, etc., certainly the highest probability of default for the next 12 months. So that's looking at the chance of a business going into administration or failing, 7.26%. Transport, post and warehousing coming in there. So obviously a lot of pressure on transport with an increase in energy costs, but then we're also seeing a downturn in terms of online retail, e-commerce as well, after 2.5 years of record highs. And of course, the third one there, very exposed to discretionary spend, which is arts and recreational services. When there's pressure on the wallet, those discretionary spend industries like food and beverage and also arts and recreation take a hit there. In terms of payment arrears by industry, we've seen quite a bit of movement with transport and accommodation starting to catch up to construction, which is typically the slowest paying industry. Doesn't always translate into risk, but definitely when you're looking at an individual business within any industry, but particularly construction, if there are recent changes in their payment behaviours, that is a leading indicator of coming delinquency. So very important to keep an eye on that and be really hyper aware of any changes to any of your customers. Great if you do that upfront check and you give them the all clear, but really important to understand what happens tomorrow, what happens next week, what happens next month, particularly as the climate, the economic climate changes, gets more difficult to trade in. You really want to be understanding how your book, how your portfolio, how your customer base is trading, and whether you've got 10 or 10,000, very difficult to do that manually. So looking at taking up monitoring and alerts, it's almost like a bit of an insurance policy to understand a set and forget, and we'll let you know when there's a significant change outside of what you're seeing at the coalface, and obviously trading with these organisations as well. So from a regional analysis perspective, what we're looking at here are the best regions and capital cities where the region has 5,000 or more businesses, so that the higher populated regions with 5,000 or more businesses sitting within them. So as we spoke about earlier, Yarra Range is performing really well. Cottesloe, Claremont coming in second, has been up the top for quite a while. You've got a number of higher sort of socio-economic areas like Chatswood, Ku-ring-gai and Warringah, of course. And then looking at capital cities versus one another, Adelaide performing exceptionally well from a low risk perspective, with Perth, Sydney, Melbourne and Brisbane making up the sort of balance there of those major sort of capital cities. Brisbane in particular doing it tough, which is really interesting because there was a big influx, obviously, of a population into Brisbane, particularly out of Melbourne and some out of Sydney. But they have traditionally, Brisbane and Queensland been a higher risk city and state, obviously very reliant on tourism as well. So it does have a little bit of a boom and bust feel about it. The worst regions, not a huge number of changes here, other than Melton Bacchus Marsh moving up the list. It's still dominated by that Gold Coast, Coolangatta, Southport area in Queensland, and then of course the Western Sydney suburbs, Bankstown, Auburn, Canterbury, Marylands and Guildford, all really doing it tough, particularly across those two regions, which we've seen now for well over 12 months since we started reporting on regional risk. From a business risk index perspective, now this is looking at the index or the rank of capital city CBDs, remembering that the higher the index, the better they are, so you don't want to be down the bottom. Brisbane had a little jump there, sort of in late 21, when they remained open a little bit longer than Sydney and Melbourne, but ultimately have come back down to bottom out at the bottom there. Melbourne and Sydney very close, and then Hobart and Adelaide and Perth performing much better. And you can see everyone's sort of fairly consistent in terms of remaining within their rank, though you can see that Sydney and Melbourne really haven't got back to where they were when we started at the beginning of this graph. You can see back in April 2019. Anneke, a bit of a sort of final couple of words or observations from you, please.
Yeah, I think that the final point is that we've seen a significant change in the outlook, even from what economists in general were thinking in January through to now. We had sort of it started with the US Federal Reserve and their decision and their commentary, which gave the world a bit of a boost. Sort of thought we might be near the end of the interest rate cycle, but then I think the Fed got a bit nervous that people were getting too confident about how well we've tackled inflation. So I think the RBA took some lessons for that and what the Fed said in their announcement, and they in turn were a lot more hawkish in their commentary in early Feb a couple of weeks ago. So I think nearly every commentator who looks at interest rates and cash rates has revised the terminal cash rate upwards. It's hard to see, with everything that the governor has been saying since then, it looks highly likely. And I think, look, most individuals and businesses had priced in one more, so we're all expecting that 25 basis point rise in Feb. Most people had just accepted that fact, but 2 or more, that's when we start presenting real serviceability problems. And like, I know the RBA are going to watch it very closely and make sure they don't induce or try to not induce too much hardship on businesses. But as always, there are marginal businesses that, if they're struggling now, another couple of cash rate rises, and that can tip many over the edge. So I guess it is downbeat, but we've got to remember this is kind of what the RBA wanted. It's a perverse logic, but they need to see this happening in the economy to get inflation down, and everyone wishes there was a better way to do it. But unfortunately, inducing slowdowns is the only way to get that inflation rate down, and inflation in the long term is much worse than higher interest rates in the short term. So I'll leave you with that outlook, and then I guess I'll hand back to Patrick to cover any questions that we might have.
Anneke, I'll ask a question that's being asked a lot. Will the governor have his contract renewed?
That's a political question, but on the balance of it today, answering the question today, you'd think not, and that's, I think, from putting my political hat on. It just wouldn't be a popular decision at the moment, and especially I think a decision has to be made in September. Yeah, so September it will be even worse. So the way politics is, it's looking unlikely, and obviously anything can change in the next 6 months.
Yeah, well answered, almost like a politician there, Anneke. All right, some questions. Great, I love it when questions come through. So the businesses that reported good performance in Q2 but were open about a softer January, what were some of the reasons for the slower start to the calendar year? The main ones that I sort of took away were particularly in the retail sector. So retail sales coming down. So some of the retailers, particularly the pure plays, the onlines, got hammered through that most recent quarter and had really poor Decembers. And then they've already started to report, even the ones bricks and mortar like JB Hi-Fi, I'm pretty sure, was reporting softer results already in January. So that's a good sign for the RBA that consumers are starting to spend less, which will mean hopefully we see inflation come down as reduce the demand. So I think that's been the general sort of sense. Less being purchased by consumers in January, and we'll see. Obviously, got to wait for those results to come out.
And Patrick, the consumer confidence survey, I think one of the questions is now a good time to buy a major household item, and I think from memory that was the answer to that question was the lowest it had ever been. So households know that they've got to put their wallets away now. Now is not a good time to be making big spending decisions.
Yeah, thank you. The next question, how are you defining trade payment defaults, slowing debt turnaround beyond terms or insolvency? So within our platform, our CreditorWatch customers can register what we call a payment default against any debtor that owes their money. It is beyond terms is the rule, so it has to be overdue. And I believe more than $100. So when we talk about probability of default, we're talking about insolvency or failure. But from a trade payment default or payment default, we're talking about a supplier, a creditor, registering a default against one of their customers or their debtors for non-payment. So overdue is the sort of key term there. We've noticed re-credit inquiries, a lot more of those entities have only been established in the last 2 years. So this is someone who's running credit checks within CreditorWatch. We've noticed credit inquiries, when they're performing a credit inquiry, a lot more of the entities have only been established in the last 2 years, some within weeks. That has been a significant change. So sorry, not a question, more of a statement there from Steve. Thank you, Steve. Yeah, I think, if you think back through COVID, there was a bit of a boom in the creation of businesses and companies as people, sort of did side gigs from home, or they were let go by their employer and they became, self-employed or forced to start their own business. So certainly we have seen an increase in the number of new companies and businesses being established. So it's nice to get that additional comment there from Steve. Of course, dealing with a new business is always tough. Traditionally, what we see, sort of generically speaking, is that the probability of default will increase sort of year 3 and 4. Generally, businesses are well funded, and the business owners, directors, have got an appetite to support a business for a couple of years, and then if it's not going so well, you see an increase in insolvencies in that sort of 3rd and 4th year. So while new businesses are certainly higher risk, that's certainly something that to take into consideration, and those sort of insights are built into our credit ratings as well. This will be a question for Anneke. Do you see interest rates decreasing in 2024?
Yes, I do. Probably not the end of 2023. Maybe end of last year. I thought the back end of 2023 it might be happening. I think based on what we know today and how demand is dropping and how bank accounts are being depleted, credit card balances are rising. I think in 2024, to get the economy moving again and to increase demand, sounds crazy today, the RBA will have to step in. I don't think interest rates will ever get back to where they were, which is 0.1%. I think those days are over, but I certainly think in 2024, the world will then have to start doing something to get the economy going again once we've got inflation under control, obviously.
Yeah, and part of me, and I agree with that. I think it's 2024. I'm somewhat cynical about announcements from the RBA, and I think a lot of people are, given we were sort of promised that nothing would go up until 2024. But they seem to have had some lessons in communication, and they're certainly being a lot more hawkish within their communications. So hopefully they're being overly hawkish, and we see softening, soft landing, etc. sooner rather than later. But yes, I agree with you. There's 2024, not before then. But there's still a long way to go. I think there's a lot of change. There's a lot of numbers out there. It's hard to be a reserve bank, central bank anywhere in the world, because every day, every week, there's new numbers that point a different way to the numbers that came out the day before or the week before. So it's certainly challenging out there. All right, we're right on time there, and I always have to remember from a poll perspective to ask, if you do wish to be contacted, please let us know. It allows us to understand exactly who wants to be contacted and who doesn't. So don't be shy to say no. But if you do, we can get in contact with you as soon as possible. It doesn't matter what you want to ask. Could be economic related question, or it could be a product or data related question. So just click the yes or no button there, or you can abstain as well. That's bringing us to the end now. Thank you for everyone who attended, as always. Great to have you with us. Appreciate your time, Anneke. So thank you for that. And no doubt you're busy reading every paper and every release that comes out at the moment to stay on top of everything. So great to have you on board with us, but to do that hard yards for us.
Pleasure.
All right, and everyone at home, thank you very much too, or home or office, depending where you're working from. We will see you very soon at the next webinar. All the best. Stay safe.
Thanks, everyone. Bye.